Hello everyone, myself Dr. Neha Karudia and I look at Pharma Sector at Abakkus, and in today's video I'm going to talk about Indian Pharma Sector and its outlook. To give you a context, Indian Pharma Sector was sized at about $50 billion for FY24. Of this, $23.5 billion were for domestic demand and $26.5 billion were total exports. Of these total exports, about 31% was towards the US market. In terms of performance, Nifty Pharma has outperformed Nifty 50 over last 1 year by about 7%. And in terms of valuation, Nifty Pharma is trading at about 26 times 1 year forward PE multiple versus 18 times 1 year forward PE multiple for Nifty 50. Now, Nifty Pharma has historically traded at a premium valuation versus Nifty 50. To discuss Indian pharma sector in further detail, the segment can be divided into four parts. One is export-focused pharma companies. Two is domestic-focused pharma companies. Three is Indian CRDMO segment. And four is domestic formulation CDMO companies. To start with the first segment, the export-focused pharma companies. So for export-focused pharma companies, the recent or current concern has been the possibility of US tariffs. Now, we believe that even if US tariffs are levied, companies will be able to pass on them and still be able to maintain their leadership in the US generics market because of their cost effectiveness. Now, most of the companies in this segment are trading at about 25 to 30 times P 1 year forward PE multiple. In terms of domestic focused pharma companies, just to give you a context, Indian pharma market grew by about 7.2% for Q3 FY25, and of this, only 0.3% was the volume growth. So, muted volume growth has been the concern for Indian pharma market over last 2 to 3 years. Now, in IPM is expected to grow at about 8% or in high single digits for FY26. These companies are typically traded at about 35 to 40 times PE multiple. Coming on to the third segment, which is the Indian CRDMO segment. This segment typically benefits from having 80 to 85% lower costs versus the developed markets. This segment, as per the recent Frost and Sullivan report, is expected to grow at about 14% CAGR over FY23 to 28. The key concern for this segment is that most of the companies see quarterly earnings fluctuations while the valuations are not cheap. Coming on to the fourth segment, which is the domestic formulation CDMO company. This segment is expected to benefit from implementation of revised Schedule M and also from the emerging trade channels like trade generics, Jan Aushadhi, and players like organized retail pharmacies, and because of which this segment is expected to grow at about 14% CAGR over FY23 to 28. Now, the companies in this segment are typically trading at about 25 to 30 times P 1 year forward PE multiple. To conclude, we remain constructive on this sector because of this sector having a stable demand market, and for the investment, one should look at the bottom-up approach analysis because each company is unique. We like companies that have diversified earnings. For companies which have US business, the US business should have lower dependence on the GREV limit sales. For the India business, we like companies that have consistently outperformed the IPM, mainly in terms of volume and new launches. We also like select CDMO companies wherein most of the earnings are from innovators or from late phase molecules or commercial molecules, or companies that are focused on the larger opportunities like GLP-1s or ADCs. That's it from my side, and thank you so much for watching.
All investments are subject to market risks. Please read all scheme-related documents carefully before investing.